First of all, if gold is already in a bull market, then geopolitical events are just adding fuel to the fire, and they have much more impactful. So we saw that with the Iran hostage situation at the end of the 1970s when gold was already in a big move. I think also if there's a lot depends on the fear and concern as to whether the geopolitical event, whatever it is, will be contained or will spread. And if the market thinks it's contained, then gold retreats. A year ago, gold was just over 1,600. It's now whatever number you pick because it changes so frequently, but it's now approaching 2,000. That is a pretty darn good rally for 1 year for an asset that's meant to be a defensive insurance asset.
As global economic uncertainty looms and recession concerns persist, seasoned financial expert AdrianDay, chairman and CEO of AdrianDay Asset Management, urges investors to brace for an impending downturn in the U.S. economy. Day offers valuable insights on shielding portfolios against market turbulence and highlights potential safe haven assets that could weather the storm. Despite recent headwinds such as the strengthening U.S. dollar and an ongoing bond sell-off, gold prices have experienced a notable resurgence, showcasing their enduring appeal as a reliable store of value. In a recent outlook report from analysts at WisdomTree, the intense geopolitical conflicts, including the recent strife between Israel and Gaza, have further propelled gold's status as a top contender for risk-averse investors seeking stability. AdrianDay, known for his expertise in navigating volatile markets, stresses that while geopolitical events typically trigger short-term fluctuations in gold prices, the precious metal has demonstrated a remarkable ability to retain its value over the long term. Citing historical examples such as the 9/11 attacks and the Russian-Ukraine invasion, Day emphasizes how these events have led to temporary price surges in gold, highlighting its role as a reliable hedge against market uncertainties. In October, gold prices rallied nearly 7%, closing the month at $1,997 an ounce. Since then, the precious metal has struggled to hold its ground at around $2,000 an ounce. Although the gold market needs another catalyst for a sustainable rally above $2,000 an ounce, October's price action does show how much potential the gold market has as sentiment continues to shift. AdrianDay asserts that from its valuation at $1,600 per ounce last year, gold has surged to nearly $2,000 per ounce. Join us as we delve into insights shared by AdrianDay in his recent video. To stay updated with our latest uploads, be sure to subscribe to our channel and activate notifications. Thank you.
First of all, there is a misunderstanding, and I'm not going to talk about me now. There's a misunderstanding about the effect of geopolitical events on gold. So when Russia invaded Ukraine and we had inflation numbers moving up, a lot of people, I wasn't one of them for those reasons, but a lot of people were saying, oh, well, gold is off to the races. Now, there's misunderstandings about the effect of geopolitics and, in fact, the effect of rising inflation on gold. First of all, with geopolitics, you look back to the 1960s, geopolitical events of all stripes tend to have very short-lived impact on gold. That was true of 9/11, that was true of lots of events, the Turkish near coup and so on and so forth. They tend to be very, very short-term events. And we saw that very clearly with the Russian-Ukraine invasion. Gold spiked, and within 3 months, gold was back to lower than where it was when it started. With regard to inflation, is what you were talking about a little bit earlier, market looking forward. When you start to see inflation pick up, the gold market says, that means the Fed's going to tighten, which is bad for gold. And so rising inflation, of course, there is a correlation between inflation and gold, but it's not a contemporaneous correlation. And so you can see that very clearly over the last 2 years. Every time the market thinks the Fed's going to pause, gold goes up, almost regardless of whether the inflation numbers are up or down. The inflation numbers move up, and the market says, "Oh, the Fed's going to hike more," and gold goes down. So there is a correlation, but it's not a contemporaneous inflation. So anyway, that's why gold didn't move as much as some people wanted it or expected it to last year. But I will say, well, last year with Ukraine,
okay,
and this year. But I will say two things. First of all, yes, this year and last year. I will say two things. First of all, A year ago, gold was just over 1,600. It's now whatever number you pick, because it changes so frequently, but it's now approaching 2,000. That is a pretty darn good rally for 1 year for an asset that's meant to be a defensive insurance asset. So gold has moved, in fact. The second thing I will say is that gold bugs, and I'm not being condescending because I'm a proud gold bug, I'm a proud member of a club, but we always expect too much. We always expect too much too soon. Well, and that's what I said in my talk yesterday. I mean, I'm glad that gold doesn't move up on geopolitical events because it'll move up for other reasons. And frankly, it's moved in the last, whatever it is, gosh, time flies, doesn't it? Not even when you're having fun, it still flies. But gold moved up not just because of Hamas terrorist incident, but at the same time, we had that turmoil in the bond market, long-term bond market,
right, yes,
with those,
yield, yeah.
I won't say failed auctions, but very, very weak auctions, where there were very, very long tails, and it was on the 3, the 10, and the 30, and then this week the 5 and the 2. 2 was okay, but the 5 was bad. So we had a series of bad auctions,
Right.
meaning the interest rate had to move up to clear the bonds. The dealers were left with more bonds on their books than they usually are, and the tails were much, much longer. So we had that, and that sort of turmoil in the long-term bond market is also what propelled gold, to be honest.
Right.
During the initial phase of the gold bull market, mining equities emerged as clear winners, significantly outperforming the precious metal itself. However, since its peak in August 2011, the narrative has taken a stark turn, with gold mining equities lagging behind the soaring trajectory of gold prices. Analysts point to various factors contributing to this divergence, with a notable impediment being the prevailing sentiment that the current gold price, hovering around $2,000 per ounce, may not be sustainable in the long run. AdrianDay highlights the potential opportunity embedded within the current undervaluation of gold stocks, particularly if the broader stock market displays signs of weakness. The recent surge in gold prices, surpassing the $2,000 per ounce mark for the first time since May, reflects the prevalent concerns over the escalation of conflict in the Middle East, overshadowing the impact of the recent spike in bond yields. AdrianDay emphasizes how the ongoing geopolitical tensions have once again amplified gold's appeal as a safe haven asset, drawing investors' attention to the enduring value and reliability of gold in times of global unrest. Let's get back to the interview.
So the gold stocks are very undervalued. We don't have to go into that. It's the same story that it was 6 months ago. Someone like Agnico is selling at pretty much the lowest price to cash flow that it has in 40 years. Which is nonsense when this company's so strong, the market's so strong, the outlook for gold is strong. So gold stocks are very undervalued. But I think we're approaching a time when we're going to start seeing the gold stocks attract buyers. If the stock market starts to falter, not crash, but falter, we're going to see a rotation. We're going to see a rotation out of the... Because if it crashes, everything goes down.
Yeah.
So I'm not trying to be funny now.
Yeah.
If it crashes, everything will move down. But if it starts to falter, then we'll start to see the tech leaders, not just the Magnificent Seven or whatever they're called, but the broader, the top 100 or 150 or 200 in the S&P. We'll start to see people move out of those and rotate into sectors that look undervalued. That will be traditional value stocks. That will be consumer staples. But it will also mean oil stocks, which are still undervalued. It will also mean gold stocks, in my view. If you're buying gold, and partly, largely, but partly, certainly, one of the reasons people have been moving into gold is for geopolitical concerns, for the safe haven. Well, if you're looking for a safe haven because Israel and Hamas are in a war, you buy physical bullion. You don't buy Agnico, and you certainly don't buy Consolidated Ajax Exploration, to pick a name out of a hat, right? The reason the gold stocks have underperformed gold is entirely dependent upon, or not entirely, but primarily dependent upon whatever reasons people are turning to gold for in the first place. Now, when the stock market starts to fall and people start turning to gold as an alternative to the stock market, then the gold stocks will perform.
What about
My sense is that Jerome Powell, particularly, some of the other Fed members as well, but let's just say Powell in particular, he would really like to have another rate hike, but he wants it to be at the right time. And he acknowledges the long lags in monetary policy. And as you say, we're beginning to see that play. It's only 1 month, but we're beginning to see a play on employment. In some ways, I think they missed their opportunity last meeting, not this one, but the last meeting. But that's water under the bridge. It's interesting to note that at this week's Fed meeting, 12 of the 19 FOMC members on their updated dot plot, are still calling for another rate hike this year. And, they're not stupid. They know there's less than 2 months left. So they're calling for another rate hike this year, 12 out of 19. So I think it's still possible we get another rate hike, which would send a message to the market, we are really serious about inflation. But at some point, whether we have one more or we don't, I think that's it. The real message now is, as many people say, tighter for longer. How long will they remain tight? Because, of course, the longer they remain, if we keep rates at the same level, the longer they keep those rates at the same level, that is in itself tightening, because the longer we keep it there, the more households and more corporations have to refinance as time goes by. And so it becomes tightening for them. The corporation that refinanced 2 years ago with 3-year maturities at 3%, they haven't, their customers may have been, but their balance sheet hasn't been affected by tightening yet. Not at all. But next year, when those maturities come due, then it hits them. So tighter for longer is a form of tightening.
Have a gold price forecast for 2025 of over $3,000 an ounce. Rich Dad Poor Dad author Richard Kiyosaki has a gold price forecast of $5,000 in the next few years, and most banks are now suggesting that gold has quite some way to go over the next 5 years. Will the projected surge in gold prices herald a new era of prosperity for gold investors, or are there potential challenges and risks that could dampen these optimistic forecasts in the coming years? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.